Something fundamental has just broken inside the global silver market, and almost nobody in mainstream finance is talking about it. Right now, two completely different silver prices exist at the same time. On Asian exchanges, physical silver is trading near the equivalent of $130 per ounce. Meanwhile, Western futures markets are struggling to hold around $83. That is not a small premium. That is a massive 47 price gap, a difference of more than 50% for the same metal on the same planet on the same day. In a normal global market, this kind of price dislocation simply cannot survive. Arbitrage traders would immediately buy silver where it is cheap and sell it where it is expensive. The spread would collapse within hours, sometimes minutes. But this gap is not closing. It is widening. And that tells us something far more serious than a temporary imbalance. It suggests the mechanisms that normally connect global markets are failing, and that a deep structural fracture may now exist between physical metal markets and paper trading systems. To understand why this is happening, we need to look at how silver pricing actually works. For decades, Western futures exchanges have dominated global price discovery. The numbers flashing across screens were treated as the official price of silver worldwide. But futures markets primarily trade contracts, promises to deliver metal in the future, not necessarily physical bars moving between vaults. As long as confidence exists in delivery mechanisms, paper pricing and physical pricing remain closely linked. What happens when confidence breaks? That is the question the current market is forcing investors to confront. Historically, we have seen brief price dislocations before. During the 2008 financial crisis, physical premiums spiked as fear spread through markets. During the 2020 pandemic panic, retail silver sold well above spot prices, yet wholesale markets stayed mostly connected, and price gaps eventually normalized. Today's situation is different. The divergence between physical markets in Asia and futures markets in the West has expanded far beyond historical norms. Instead of shrinking, the spread has accelerated over a very short time period, from modest premiums into a dramatic structural divide. This suggests that the issue may not be logistics or temporary panic. Instead, it points towards shifting supply flows, changing demand patterns, and potential stress within traditional delivery channels. And once investors begin questioning whether futures prices truly reflect physical availability, the entire pricing system enters dangerous territory. Because silver is not just another commodity. It is both a precious metal and an essential industrial resource used in solar technology, electronics, medical equipment, and advanced manufacturing. When pricing disconnects from physical demand in a metal this critical, it sends shockwaves through the global economy. So what is actually driving this divergence? Why is the physical market behaving so differently from the paper market? And what happens if this gap continues to grow instead of shrinking? To answer those questions, we need to examine the forces reshaping global silver demand, especially in Asia, and how strategic accumulation, industrial consumption, and investor behavior may be redefining the market's balance of power. Have you ever looked at the price of a commodity, like silver, and noticed something strange? The price you see on the news, the futures price, is telling you one story, while the price to actually buy the physical metal tells a completely different one. This gap, this divergence between the paper market and the physical market, is a huge signal, and understanding it is key to navigating what's coming next without getting caught up in hype or panic. So what does it really mean when these two prices start to drift apart? First, let's break it down. The futures price you see on your screen represents a financial contract. It's a bet on where the price will be at a future date. It's traded on exchanges like COMEX and is deeply tied to the world of finance, derivatives, and speculation. On the other hand, the physical market price is what you pay to get the actual tangible metal in your hand. This price reflects real-world supply and demand, right here, right now, in specific locations around the globe. When a gap opens up between them, it doesn't automatically mean the market is about to collapse, but it does signal a serious tension in the system. It's like a rubber band being stretched. The question is, will it snap back or will it break? Think about it from the perspective of an industrial company. If you're building solar panels, electric vehicles, or advanced electronics, you need real physical silver. You can't run a factory on paper contracts. These manufacturers are the bedrock of physical demand. If they start finding it difficult to source the metal they need, or if they have to pay significant premiums over the official paper price, they won't just shut down. They'll pay what they have to because the cost of stopping production is far greater. This willingness to pay higher prices for the real thing pushes physical premiums even further, widening that gap. This is where things can get very interesting and potentially very volatile. If the physical market continues to get tighter and premiums keep rising, at some point the paper market has to react. It can't ignore reality forever. Imagine a scenario where the futures market suddenly tries to catch up to the physical price. This could trigger an incredibly rapid upward price movement. All those investors who have short positions, betting that the price will go down, would face immense pressure. They might be forced to buy back their contracts at much higher prices to cover their losses, which only adds more fuel to the fire. This is what's known as a short squeeze, and it can cause volatility to spike dramatically. Investors who are relying purely on financial derivatives, who think they have exposure to silver, might get a harsh lesson. They might discover that liquidity, the ability to easily buy or sell, behaves very differently during periods of extreme market stress. That paper claim on silver might become very difficult to convert into a real profit when everyone is rushing for the exit at the same time. However, it's crucial to stay grounded and realistic. Markets are incredibly complex. They're influenced by central bank policies, changing exchange rules, and the overall health of the global economy. A sudden, violent repricing event is always possible, but it's never a guarantee. There are powerful forces that have an interest in maintaining stability in the paper markets. So, while the tension is real, predicting the exact timing and nature of its release is nearly impossible. What is undeniable, though, is that this divergence points to a changing global landscape. For decades, Western exchanges like the COMEX in New York and the LBMA in London have been the primary centers for price discovery in precious metals. But that might be changing. The balance of power and commodity pricing could be shifting. We're seeing a move towards regions where physical delivery and real-world trade play a much larger role. As more and more trade happens outside these traditional Western systems, the influence of currencies like the US dollar and the geopolitical leverage that comes with controlling commodity prices could also evolve. We are in the middle of a major shift. So, what does this all mean for you, the individual investor? The key takeaway here is not to panic, but to be aware. The first step is to truly understand the difference between paper exposure and physical ownership. They are not the same thing. A silver ETF is not a stack of silver bars in your vault. Recognize that in times of market stress, things like premiums, availability, and even the terms of delivery can change in the blink of an eye. This is why diversification and solid risk management are more important than ever. In a volatile environment, you don't want all your eggs in one basket, especially if that basket is made of paper. Silver holds a unique position in the modern economy. It has this dual identity. On one hand, it's a critical industrial metal, essential for our green energy transition and technological future. On the other hand, it has thousands of years of history as a monetary metal, a store of value. This combination makes it uniquely sensitive to shifts in both the financial world and the real-world manufacturing sector. That price gap we're seeing, it will eventually close. The laws of arbitrage say it must. The trillion-dollar question is how. Will it be a gradual, orderly adjustment as markets slowly find a new equilibrium? Will it be a sudden, volatile event that catches many by surprise? Or will it be part of a deeper structural change in how global commodities are priced for good? What we are witnessing right now could be far more than just a temporary glitch or anomaly in the market. It might be an early tremor, a warning signal of a much deeper transformation in how we value real physical resources in an increasingly complex and multipolar financial world. The story is still unfolding, and as it does, the most important thing you can do is stay informed, stay analytical, and learn to separate the real market data from the emotional narratives and the noise. Because in times of great uncertainty, the biggest advantage isn't speed or trying to time the market perfectly. It's clarity. Thanks for watching. If you found this valuable, be sure to subscribe for more insights. Have you ever wondered what's really going on behind the scenes in the global silver market? We're seeing some strange signals, a tension that could point to a major shift in how we value precious metals. It's a story of industry, investment, and a growing divide between the physical world and the financial one. So, what is this powerful force shaking up the market? A lot of it starts in Asia, with a massive surge in physical demand. Let's break it down. First, you have industrial growth. Silver isn't just a shiny metal sitting in a vault. It's a critical component in modern manufacturing. Think about the green energy revolution. Solar panels are a huge consumer of silver, and as countries build out their renewable energy infrastructure, that demand just keeps climbing. It's also essential for electronics, from the smartphone in your pocket to the complex systems in electric vehicles and 5G networks. All these high-tech industries depend on silver's unique properties, especially its incredible conductivity. Because silver is so vital, manufacturers are getting nervous. They can't afford to have their production lines shut down because they can't get their hands on the raw materials. So instead of just buying silver on the spot market whenever they need it, they're changing their strategy. We're seeing a trend toward long-term purchasing contracts and strategic stockpiling. These companies want to lock in their supply for months, even years, ahead of time. They're trying to insulate themselves from price swings and potential shortages, and this proactive buying puts a constant upward pressure on physical supply. But industrial demand is only half of the story. The other half is investor behavior. When the global economy feels shaky, where do people put their money? We've seen it time and time again. When property markets get wobbly, when currencies lose their value, or when the stock market feels like a roller coaster, many investors flock to tangible assets. They want something they can hold, something that has a long history as a store of value. Gold and silver have always filled that role. So, as economic uncertainty lingers, more and more individual investors are buying physical silver coins and bars. When you combine this relentless industrial demand with strong investment demand, you get a powerful double whammy pulling on physical inventories. Warehouses are seeing more metal go out than come in. This is where things start to get really interesting and, frankly, a little complicated. Normally, the global market has a built-in balancing mechanism called arbitrage. The idea is simple. If the price of silver is much higher in London than it is in New York, traders will jump in. They'll buy the cheaper silver in New York, take delivery of the actual metal, ship it to London, and sell it for a profit. This process happens constantly, and it keeps prices around the world pretty much in sync. A small difference is normal, but big gaps usually get closed very quickly. But right now, we're seeing persistent price differences between major trading hubs that aren't being corrected. This suggests that the arbitrage process, that crucial balancing act, isn't working smoothly. Why not? There could be a whole host of reasons. Maybe there are delivery delays at the warehouses. Perhaps shipping the metal has become too difficult or expensive. There could be new regulations or export restrictions, making it harder to move large quantities of silver across borders. Or maybe traders are having trouble getting the financing they need to execute these large trades. Another critical possibility is that the available supply of physical silver bars, the big 1,000-ounce bars used for settlement, is tighter than people think. Not all the silver in a warehouse is available for sale. Much of it might already be allocated to ETFs or other owners. If there isn't enough unencumbered metal to easily move around, arbitrage breaks down. This leads to a dangerous feedback loop centered on one thing: confidence. The entire futures market, where most of the world's silver price discovery happens, is built on the confidence that you can, if you choose, exchange your paper contract for the real physical metal. But what happens when traders start to doubt that? When they start to worry that if they demand delivery, they might not get it, or at least not without a major hassle? Once that confidence starts to crack, the system begins to change. Liquidity, the lifeblood of any market, can start to drain away from the traditional exchanges. Think about it from the perspective of a silver miner. If you can sell your newly mined silver directly to an industrial buyer for a significant premium over the futures price, why would you bother delivering it into a complex exchange system for less money? You wouldn't. You'd take the better deal. Refiners might do the same. If they see huge demand and high premiums in one part of the world, they'll redirect their shipments there, bypassing the exchanges. And as we already discussed, the big industrial users are increasingly trying to secure their supply directly, cutting out the middleman entirely. As this happens, the very nature of price discovery starts to transform. For decades, the futures markets in places like New York and London have been the primary drivers of the global silver price. But if more and more transactions are happening off exchange in the physical market at higher prices, which price is the real one? The price of a paper contract or the price of actual metal changing hands? Slowly but surely, the physical transactions start to carry more weight. The real market, where real silver is bought and sold for real purposes, begins to assert its influence over the financial or paper market. This shift could have enormous consequences that go far beyond just the price of silver. The futures markets operate on leverage. A huge number of contracts are traded every day, representing a volume of silver that is many, many times larger than the amount of physical metal actually held in the exchange warehouses. The system works because only a tiny fraction of contract holders ever ask for physical delivery. Most just settle their contracts in cash. But if a larger than usual number of participants all demand physical delivery at the same time, it would put immense stress on the exchanges. They might be forced to change the rules, perhaps offering cash incentives for people to not take delivery, or implementing other emergency measures to avoid a default. This doesn't mean the system would instantly collapse, but it's a clear signal of serious stress. It shows that the system was designed for financial efficiency, not for large-scale physical withdrawal. What we might be witnessing are the early stages of a historic decoupling, a separation between the physical silver market and the financial derivative market that's supposed to represent it. The price of a paper claim on silver could start to diverge significantly from the price of having the actual metal in your hand. And if that separation accelerates, the ripple effects could be massive. It could challenge the way all commodities are priced. It could impact currency dynamics, as the role of physical metals as a monetary backstop comes back into focus. It could even affect geopolitical power structures, as control over real physical resources becomes more important than control over financial markets. This brings us to the final and most important question. If the physical market for silver continues to tighten, with real buyers paying ever higher premiums to secure supply, while the paper markets struggle to keep pace and maintain confidence, what happens next? Are we on the cusp of a repricing event where the world is forced to reevaluate the true value of physical silver? It's a question with no easy answer, but watching this space has never been more critical. The tension is building, and whatever comes next is sure to be fascinating. Thanks for watching, and don't forget to subscribe for more deep dives into the markets.